You see a stock like AMD beat revenue expectations by hundreds of millions of dollars, and then you watch it drop 10% in a single day, and you think, what is wrong with my portfolio? Look, your portfolio isn't broken. You're just missing the one sentence in their earnings report that Wall Street is completely ignoring, deliberately. If you're short on time, here's the single most important takeaway. AMD's official guidance for next quarter, the numbers everyone is reacting to, assumes they will sell 0 of their top-tier AI chips to China. It's a free lottery ticket that the market has decided is worthless. I will first explain the fundamental story here, followed by its fascinating technical picture later. If that sounds like the kind of detail you need to understand, stick around and maybe consider subscribing. Hey everyone, for those of you who are new here, my name is DataCat. I used to be an analyst, you know. One of those corporate cats stuck in a spreadsheet working inside a pretty big Fortune 50 company. My job was basically to stare at numbers while drinking 4 cups of coffee until they made sense. I eventually traded that whole corporate grind for a keyboard and, well, a laser pointer. I figured I could do more good here, trying to cut through the noise and look at the data for what it really is, without a corporate agenda attached. I'm not here to brag, just to share my analysis. So let's talk about AMD. This situation is a perfect example of how market psychology can completely warp reality. If you've watched my previous videos, you'd know that right now the market is, well, it's a scaredy cat. It's in this bad news is bad news funk where any little shadow, any unexpected sound sends it scurrying for cover. In a normal, healthy market, AMD's report would have been a cause for celebration. I mean, let's look at the numbers. They reported $7.7 billion in revenue. The expert consensus was $7.43 billion. That's not just a beat, but a massive one. And it signals incredibly strong demand. And this wasn't a one-trick pony either. Their data center, client, and gaming divisions all posted huge year-over-year gains. The core business is firing on all cylinders. And the AI narrative, the story that has been propping up this entire market, it's completely intact. Major cloud companies are adopting their MI300 AI chips, confirming the demand is real. They even guided for 28% year-over-year growth for the next quarter. So you have to ask the question, why did the stock get punished like it just knocked a priceless vase off the mantelpiece? This is where you have to learn and understand how a fearful market thinks. Investors weren't reading the report looking for reasons to buy. They were scanning it with a magnifying glass, desperately searching for an excuse to sell and reduce their risk. And they found a couple of things to latch onto. The first was the margin shock. Their non-GAAP gross margin fell to 43%, a 10-point drop from the year before. For a company's profitability, that's a huge red flag. And the cause? An $800 million charge directly resulting from US export restrictions to China. All of a sudden, that big, scary geopolitical trade war headline has a number attached to it. A very specific, very painful $800 million number. The second crack they found was that even with revenue soaring, their earnings per share, the actual profit, was just in line with estimates and down from last year. In a risk-off environment, the market wants to see strong sales translate directly to the bottom line. When it doesn't, it signals that growth is becoming more expensive, less efficient. It's like trying to run up a slide. You're putting in a ton of effort just to stay in the same place. But buried deep in that report, there was one sentence. A sentence that, in my view, is arguably one of the most important in the entire release. And this is the part that most people, and frankly most trading algorithms, will just gloss right over. I'll read it to you directly. Our current outlook does not include any revenue from AMD Instinct MI308 shipments to China, as our license applications are currently under review by the US government. Let's really unpack what that means for you as an investor. Management has effectively de-risked their own guidance. They have set the bar on the floor. That strong forward guidance of $8.7 billion for the next quarter, that's the baseline number without selling their most powerful AI chip to one of the biggest tech markets on the planet. This creates a fantastic asymmetry, perhaps like a free call option. Think about it. If the license application is denied, what happens? Nothing. The market has already priced in zero revenue from this. It's the expectation. there's no new disappointment. But if that license is approved, you are looking at an immediate and significant upward revision to their revenue and earnings guidance. It represents pure, unexpected upside that is not currently baked into the stock price at all. This single point also completely reframes that whole margin discussion. The margin compression isn't just a sign of random weakness. It's a direct consequence of a specific, isolated government policy event. If that policy event is reversed, it implies a significant margin recovery is possible. Okay, so the fundamental story is compelling, but what does the chart say? Are we trying to catch a falling knife, or is this a healthy pullback? If you zoom out, the stock is in a healthy, long-term uptrend. It's still comfortably above its 200-day moving average, which is the major trend line that big institutions watch. This recent 10% drop brought the price right back to its 20-day moving average, and the RSI, the momentum indicator, has cooled off from being overbought back to a neutral zone. The key battleground to watch is the $140 to $150 support zone. This area represents a significant prior consolidation range, and it's right where the 50-day moving average is trending. A pullback to this level wouldn't break the uptrend. For many trend-following investors, it would represent the ideal buy-the-dip opportunity, allowing the stock to consolidate and build energy for its next move. So let's put all the pieces together. What is the actual risk versus the reward here? The risk is defined. It's the macro environment. It's the possibility that the market keeps panicking and pushes AMD below that 50-day moving average and down towards that $140 support. That seems to be the logical line in the sand for a healthy pullback. The risk feels relatively quantifiable. The potential reward, on the other hand, is significantly larger and comes from multiple layers. You have a potential technical bounce as the current panic subsides. You have the market eventually looking past the short-term margin issue and rewarding the incredible revenue growth. And then you have the wildcard catalyst, the massive asymmetric upside from a potential approval of that China license, which again is currently valued at zero by the market. You're not looking at a company with a broken business. You're looking at a strong company being temporarily punished by a fearful market. This pullback provides a cushion, creating a runway for a significant uptrend once the macro fears ease, or more powerfully, if the company gets the green light on its China license. To me, this is what a calculated, strategic investment setup looks like, not a speculative gamble. Anyways, that's my take on it, but remember, I'm just one cat with a keyboard, so you should always do your own research. If you want more deep dives that go beyond the headlines to find the real story in the data, make sure you subscribe to the channel. I'd be curious to hear your thoughts. Do you think the US government will approve that license for AMD? Let me know in the comments below. Alright? DataCat out, stay sharp and stay safe out there.